Verizon stock is actually up an incredible 32% over the past year. I think that's surprising when you consider how long this company's kind of been stuck in a rut, but still a very good dividend yield at 6.4% as I'm recording on Tuesday. The company reports earnings next week on the 22nd. So I want to go through exactly what I'm looking for in earnings. This is one of my larger holdings. I hold it because it's such a good value stock, consistent earnings, consistent revenue, and I think there's growth potential in both broadband and the internet that they're bringing to people's homes and to businesses. So layering that on top of the services that they're providing for smartphones, and then also bundling that they're going to be bundling with streaming companies. I think we're going to hear more and more about that in earnings. Layered on top of those positive developments is the fact that interest rates are starting to go down. So the pressure that Verizon felt as interest rates were going up could potentially ease a little bit in 2024 as they have to refinance some of their debt in coming years. That debt gets more and more expensive as rates get higher. But if rates are going to come down in 2024, as a lot of investors expect, that should help the company's cash flow. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's get to the recent results and just put the numbers into context for what to expect next week. This is the first page I always look at from Verizon's earnings, and there are a couple of things to notice here. First, the consumer business has been pretty weak over the last year or so. They had a pretty good fourth quarter, but then back to negative customer additions, so basically customer losses in the first quarter of 2024. Business, on the other hand, has been doing extremely well. So a little bit of a bifurcation there. If you look at AT&T's results, you actually see the opposite happening at AT&T. They're doing really well with consumers, not as well with businesses. What has done really well for Verizon over the past year is broadband and this fixed wireless access. This is the box that you just simply plug into the wall to get broadband access to Verizon's 5G network. There have been in excess of 300,000 additions each quarter. Now, a lot of investors think that there's limitations to how many customers they can add to My Home, which is the product that they're offering. We haven't seen that actually be a problem yet, so we'll see if management talks a little bit more about that and any sort of limitations on how many customers they could potentially add to broadband. But I think this is a good problem to have. If you have too many customers who want your product, that's a great problem. The great thing about having these two solutions for consumers is that now when a customer goes into a Verizon store, they're not just looking at what is the smartphone that I can buy, what is the deal I can get on that smartphone, and then what is my monthly rate going to be. They can go in and say, oh, for an extra $35 a month, I can get broadband. That sounds like a great deal. Verizon benefits from that because they have built out the infrastructure. So the 5G network is actually what's most expensive. They have very, very high margins on their services. I'll get to some of that in just a second. But they actually lose money when they sell customers a smartphone, and they make money on the back end as they pay their monthly bills. That's what's 60-70% margin. So if you can add any margin from broadband, that is icing on the cake. Layer in potential bundling with streaming services, and that's just another revenue source that becomes stickier and stickier for customers. When we look at revenue, there's two ways that we want to look at revenue for Verizon. The first is the services revenue. I talked about that just a second ago. Services revenue is going to be very high margin. The wireless equipment revenue, which is just the top number, $33 billion minus $27.6 billion, is actually going to typically be a negative margin. So if they have revenue that declines, but it's declining in wireless revenue, that's actually good for the business. It doesn't really seem logical on the surface, but that's why they break these two things down into different segments. Wireless services revenue is the biggest one that you want to watch. Services revenue includes things like their fiber optic business and any other businesses. But wireless services revenue is going to break this down even further. This is what you want to see growing. A 3.3% growth rate doesn't sound like a lot, but for a company at the scale of Verizon, that's actually a pretty solid growth rate. You'd like to see that maybe even a little bit higher, but if they get up to a 5-6% growth rate, the stock is actually absolutely going to take off. So don't set those expectations too high. But if they do keep chipping away and growing wireless services revenue, that's great for the business. Cash flow is the other thing that I'm going to be keeping a very close eye on in a couple of key numbers here. Cash flow from operations, this is a little bit volatile quarter to quarter, but you want to see this trending higher over time. And then capital expenditures we have seen lower significantly over the past year or so. And this is a big reason that free cash flow is beginning to be solidly positive. So you want that operating cash flow to be going up, capital expenditures to be going down. That leaves you excess free cash flow. That cash flow can be used for two things. They can pay the dividend, which they continue to do, or they can pay down debt. The problem last quarter, as you see here, is you're paying out more in a dividend than you're generating in free cash flow. So that's not actually going to help your debt situation, even though the debt is down just a little bit year over year. And unsecured debt, this is a measure of leverage that they use, unsecured debt to adjusted EBITDA, 2.6. So that's a reasonable margin for Verizon, but I would like to see this number come down significantly. Management has talked about starting to do that, starting to use that free cash flow to pay down debt, but I would like to see them do that very aggressively so that they're not so tied to interest rates and the potential rise in interest rates. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The reason I think there's reason to be optimistic for the second quarter of 2024 and for the rest of the year is Verizon continues to make all the right strategic moves. They've built out the 5G network that continues to expand. Now they're moving into bundling services. This is something that they've never really been able to do successfully in the past because they haven't had a great broadband service in most of the country. In certain areas, they do have fiber optics. But where I live, that's never been an option. So you basically just gotten your smartphone from one of the carriers. Verizon is one of the biggest where I am. But there was nothing really to bundle with it. So now you can bundle not only that smartphone service, but also broadband for your home or business. And then layer on top, they're giving discounts to streaming services. So streaming services like Disney Plus, like Apple TV, like Max, they want to have more customers. They're willing to give up a little bit of revenue on a monthly basis. They're going to keep all their advertising revenue. That's one of the reasons that advertising is such a big deal for them long term. But they want to have customers in their ecosystem. So they're willing to say, okay, maybe our sticker price is $10 if you go sign up for our service online, but we will just charge Verizon $7 a month, let's say, to be a reseller, to bundle this service in with their services. And that can be a value add for everybody involved. What it ends up doing is it takes multiple components of the media ecosystem and the telecom ecosystem and bundles it together for a lower price. Yes, you maybe don't necessarily get as much value out of each discrete piece, but overall, all customers are getting more value at a lower price, and that is what ultimately reduces churn. This is the same model that was used in the cable industry when they had their triple play, where they would have cable TV, cable internet, and then phone as well. So this is basically just that same model moved over to telecom. So I want to see some evidence that that is going to gain traction for Verizon, because I think strategically, that's theoretically the right thing to do. It's good for Verizon. It's good for their broadband business. Streaming is going to bring incremental revenue. It's great for the streaming companies because they're able to bring tens of millions of customers into their ecosystem. But is this something that customers actually want? Do they actually want to sign up for a streaming service through Verizon? That is the outstanding question right now. But I think we're going to see positive momentum on all of these fronts and look for debt to be something that they look to pay down while keeping that dividend relatively high, 6.4% dividend yield. So even just for holding stock, you get a nice payout. And on top of that, the stock has done pretty well over the past year. But hopefully that gives you an idea of what I'm looking for from Verizon's earnings report. If they report better than expected earnings and we see some momentum on the growth side, some of these bundling economics improving the business, don't be surprised if the earnings multiple starts to expand and that stock starts to rise from where it is today. So I think a lot to like about Verizon's position today. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.